Welcome back. This is SeeWing Yee from the Year Real Estate Network, and today's topic is I'm going to compare our duplex co-living new construction rent by the room, 14 bedroom, 14 bathroom, 600K to $650,000, a duplex with 14 doors, co-living, compared to a traditional duplex. So you can, so we can evaluate as close as possible the apple to apple comparison. So by the end of this video, you can evaluate and do your research and do your due diligence and make an informed decision whether you should buy a traditional duplex in the few markets that I'm going to share that with you versus a co-living duplex. All right, so with that in mind, let me share my screen and get the show rolling. This is going to be very insightful, very interesting. So, all right, so here we go. So this is our duplex, one of the investment model we have, brand new 1414, one bedroom to one bathroom ratio, which is amazing, located in Jacksonville, Florida. So we have other new construction markets, other investment models in other parts of Florida and in Texas. But today, I'm just going to talk about apple to apple comparison, 600K property at 20 to 25% down payment. All right. And with a mortgage rate anywhere from 5.5% to 7.5%, depending on the DSCR loan that you may be able to get. That debt service coverage ratio is the main loan program for this type of co-living properties, which is, needless to say, co-living rent by the room model, rent to workforce housing tenants is I believe, is one of the fastest growing real estate asset class in the country. And so, okay, so this is the interior of our typical new build, strictly co-living type situation. And let me share with you the numbers, which is very critical. I'm not going to go over every metrics, but you can pause the screen and look at these metrics. It is just an estimate. It's just just a pro forma, right? And the disclaimer is, of course, you have to consult your financial advisor to determine whether this type of strategies make sense to your goals, your risk tolerance, and the whole nine yards. All right. So do what's right for you based on your goals and consult with your licensed financial advisors. All right, so here are the numbers. At the end of the day, this 1414 model we have rent by the room, one bedroom to one private bathroom ratio is the best type of co-living properties. So typically we rent for like $1,000 per month per member tenants. We use Pass Split as a marketing tech platform, and we use a co-living property managers to do the day-to-day housekeeping and everything else. So this is strictly 100% turnkey, just hands-off type of investment. So so you don't need a second job. You have time freedom. Does not matter how many of this co-living turnkey new construction property you buy. You have very minimal time managing your portfolio, regardless of where you live in a country. So again, the breakdown is almost 14 grand, $1,000 per month. Easy math, $14,000 gross rent that we minus the Pass Split marketing fee, typically 8% of the rent, and additionally, property management also another 8% of the gross rent. And the whole and everything else, as you can see, is very clear cut. All right. At the end of the day, you're gonna get about in excess of around $5,000 monthly cash flow, which is iconic. We're talking $60,000 of net annual cash flow. I mean, that's incredible and better pro forma. As you can see, your down payment, around $176,000. You do the loan, the whole nine yards. I mean, the returns are outrageous, right? The cap rate is 16.5%, cash on cash return 36%. Return ROI at the end of the first year, if you incorporate all the appreciation projection, the cash flow, and the principal pay down, and the whole nine yards, your total ROI at the end of the first year is anywhere from 50 to 60% on this co-living projection. So let's compare, right? This is exciting. No one ever taught you this kind of stuff before. So we can compare our 600K duplex, 14 doors in one building, okay, in one structure, okay, is by definition a duplex residential investing methodology, okay, versus a traditional new construction duplex long-term rental in San Antonio, Texas, which is a very hot market. Okay, we know all the markets in the country. I've been promoting turnkey cash flow long-term rentals in many markets over my 20 something years to hundreds of our investors across the country. And San Antonio is one of the top market in the past and even right now. So this is a beautiful, don't get me wrong, okay? I'm trying to be as objective as possible. This is a beautiful current listing of these duplex in San Antonio. Beautiful, inside, outside. Is a duplex selling for 625K on each door. So each door like 312,000. And the rent, by the way, is $2,000. This is a long-term rental rate, right? $2,000 monthly gross rent per door, which is 312,000. And people buy it, right? Investors from all over the country, they buy this type of brand new construction long-term rental in San Antonio and elsewhere throughout many many years. Okay, and we have investors over the years have bought something like this in this market in this type of asset. But as you can see, they only rent, barely less than $2,000 per door, three bedroom, two bath, 1380 per square foot per door. Everything looks good. And interior looks very good, just very turnkey. The warranty, the whole 9 yards is turnkey, and they have professional property management just like us, and they are getting a 3.5% buyer's rate buy down. Even 3.5% rate buy down, at the end of the day, this long-term investor buying this duplex with a total out of pocket of $146,000 at 25% down payment, even with a rate buy down of 3.75%, 10 year, the first 10-year fix, whatever, even a 30-year fix, is an amazing incentive. And yet, the monthly net cash flow is barely $784, right? If you compare to our duplex, the co-living duplex, our net cash flow is in excess of $5,000. We talk like 7 times greater cash flow with the same purchase price, same down payment, and even our mortgage rate with the co-living using DSCR loan is at 7% or more 30-year fixed, and we can still beat. Do the math, right? I mean, look, I'm not saying it's bad to buy this brand new property in this path of growth in San Antonio, and brand new duplex, long-term rental. But without a buyer incentive, let's say without this rate buy down of 3.575%, without this, an investor most likely in the open market getting an investment loan will be like 7.5% rate, 30-year fix, or even 8% rent rate without any kind of buy down. If that's the case, if you do the pro forma, if someone buy this duplex without this special builder incentive, 3.75, if you get like 7.5% 30-year fixed rate mortgage for investment loan, traditional Fannie Mae type of guideline, guess what? You may not even get any kind of cash flow. You get zero cash flow, maybe even a negative cash flow with 25% down payment, and you fork up $146,000 before closing costs and everything else, and only get break-even cash flow with a 7.5% rate. Okay, okay, the numbers just doesn't make sense, even though this is a quality asset, decent B plus neighborhood and all that, good rental market, the whole 9 yards. So just like that, it's just I don't know. You tell me, right? I'm not gonna steer you one direction or another. Okay, would you want $5,000 monthly cash flow in a brand new duplex that we have 600 to 600K, 650,000 in Jacksonville, Florida, one of the fastest growing market in the country as well, Jacksonville, Florida, right? Even with a higher rate. I mean, what, 7 times greater cash flow with the same amount of down payment? Okay, so it's a no-brainer. So no, you now I'm not gonna say no-brainer. You tell me what, okay? Okay, I want to be objective. Okay. At the end of this video, I want you to make an informed decision based on what is right with you, based on what align with your goals and objectives. If you want to buy a long-term rental, okay, a duplex or whatever, as long as this is your buy box, as long as you feel comfortable, as long as you understand the numbers, as long as you understand the apple to apple comparison, what is out there, right? Every market is different. There are 20,000 cities in the country. There are 6,000 counties. So, we have, as investors, we have opportunity to buy different type of real estate asset classes. I'm not telling you, oh, strictly buy the co-living just because we have an amazing cash flow, amazing cap rate, a cap rate of 14%, cash on cash return at almost 30%, total ROI 50 to 60%. Yeah, the numbers is very, very enticing. But I mean, I'm into it co-living, right? This is our investment model within my organization. But you as an investor have to determine your buybacks. What's right for you is not only about the numbers, but I'm talking numbers because this is the only way I could do an apple to apple comparison. So you have to look beyond the numbers. Is it co-living? Could be part of your portfolio. You want to accelerate your retirement. You want to retire early. You want more cash flow. You want to have a good stable market. You want to have a good team, good property manager, a good marketing platform like PassSplit can help you delegate and outsource, right? So it all is all up to each individual. At the end of this video, what do you think is right? So I know subjectively, what I want, right? But I want to be objective, okay? That's why I want you to be smart about it, make an informed decision, do your research, do your due diligence, and make an informed decision to what investment model you want to buy, what location, and what's your expectation, what's your goals in the whole 9 yards. Okay. Having said that, I'm gonna use another rental property, this time located in Columbus, Ohio. Yes, in the Midwest, 599K duplex. Another apple to apple comparison. So here we go. And so I pulled this information out of this multi-listing website. It's called LoopNet, which is indicated on here, right? So Columbus, Ohio, duplex. Okay, as you can see, okay, as you can see the outside for inside, this duplex presumably is turnkey. I don't know. Maybe require a little bit of cosmetic repair. I don't know the details of it, but at the end of the day, well, they say it's renovated. Okay, it's 2 units. Let me see what else I can find here. Well, one red flag that I see from my personal perspective is built 1900. Okay, it's built at the turn of the century, during the Renaissance era. And the airplane was not even the Wright brothers did not even create the airplane back in the Wright brothers, I think, created an airplane like 1904. So yes, it was renovated recently, right? This property, but still the bones, the foundation, the bones are still more than 100 years old, 126 years old, in fact. So what, and people buy, right? People buy Midwest market all the time. Real investors on a daily basis, they transact, especially people who live in Midwest, they feel comfortable to buy in their own backyard, if you will. They don't care if the property is 100 years old. I care because I want my property to last a long time without CapEx, without maintenance and upkeep and capital expenditure and all that stuff. So I like brand new construction to be honest with you. But hey, everybody have their own buy box. Everybody have their own criteria. But think this property in the next 20 to 30 years is going to be 140, 50, 150 years old. How can you do a generational wealth transfer? But before you know it, with all the actual costs that can eat into your cash flow, the maintenance and upkeeps and everything else, you may not keep this generationally to your loved ones after a few years. All right. So let me see what else I can. Yeah. So that's right. That's what you get. And I don't know what the rent per door is only like 1,700. So $3,400 total gross rent on a almost 600K purchase. Yeah, I know they say 5.75% cap rate, but the cash flow, I don't know. The cash flow is a couple of $100 maybe on this old property in the Midwest, whereby Midwest they have very old housing stock, right? The neighborhood. You can make the argument this kind of neighborhood is not so great. It's a C class neighborhood, maybe C plus or C class. I don't know. I don't know. Could be a you could be a slumlord, managing, owning this kind of property. Personally, I don't know. I don't know. The numbers cannot even closely compare, right? The cash flow, all the returns, all the numerical metrics we discussed, it's really not an apple to apple comparison. And yet, I would not be surprised this kind of properties get sold, within a few months. I don't know. Okay, the next comparison, I'm going to use it, this 6 unit. It is a multi-unit. This is an apartment multi-unit. However, you can have there's no more 30-year fixed rate because when you buy anything above a 4 unit, you are no longer qualified for the conventional financing 30-year fixed rate under the residential investment category, right? You're buying a multi-unit, which is not a 30-year fixed, which is a adjustable loan, right? So that's very, very risky for anybody venture into a multi-unit because a loan program are not that desirable. Okay, a lot of people got burnt using a multi unit loan. So a lot of multi units market are not doing well. For the lending part is one reason. All right, but anyway, another property I'm going to share with you. This is a 6 unit apartment building located in uh, Milwaukee, Wisconsin, all right, part of the Midwest kind of deal. In case you do not know, you're not aware, Midwest type of housing stock are very old, okay? Uh, and they cannot build because there's a lot of zoning restrictions, a lot of all the cities all over Midwest, uh, they do not they don't have new constructions. Everything's old, right? They're gonna get a lot older in years later. So the new builders, they do not go into Midwest because it's very hard to build. The cost because of the weather and all that stuff. I'm not going to get into that, but you're not going to find any new construction in the Midwest. Okay, but in the South and Southeast, where that's my playground. Yes, especially Florida and Texas, very, very robust. A lot of new construction. The path of growth, population growth, job growth, migration growth is happening in Florida and Texas for years and decades and to come. That's why I like this region. So this property is a 6 unit, $600,000, $100,000 per unit. The cap rate is kind of high, 8.03%. So the cash flow on paper looks good until the cap rate and all the maintenance and issues and vacancies can affect your paper cash flow, if you will, right? So look at the interior, very old, a little bit turnkey. It's just very old. How old? I'll show you momentarily. You see, you have to do an inspection. If anybody buy this property, they have to do an inspection report, make sure everything's up to date. If not, hey, it might come out of your pocket for the renovation, right? Who wants that? So add some extra layer, extra cost, and everything else. So look at the backyard and look at here the basement. It's and built exactly 100 years ago. Okay, all right. Here's all the details of interior of the house. And okay, some of you are clearly by the numbers. Okay, we can only go by the numbers. The cap rate seems high, so the cash flow is decent. So the seven separate unit of this multi-unit apartment building have a gross rent of 80 grand before any deductions. So we're talking about $1,000, right? A little more than $1,000 per unit, similar to our duplex, our co-living duplex, right? $1,000 per room, right? And we have 14 rooms in one structure, in one loan, in one property, but you have 7 different units, doors. It's a multi-unit, as I mentioned earlier. So a lot more, a lot more work to maintain a 7 unit old apartment, 100 years old. Yep, the cash flow is kind of similar, right? No, not similar actually. Is a $7,000 monthly uh, gross rent, but the monthly gross rent for our unit is 14,000, right? Our co-living duplex, as I showed you earlier, $14,000 times 12 months, you are potentially collecting $168,000 on our co-living new build duplex, 14 bedroom, 14 bathroom for workforce housing, which is a very fast growing rental market, right? You rent by the room, you rent to those blue collar workers, you rent to people that cannot even afford a one bedroom apartment in the particular market, so they save a lot of money by renting by the room. So the workforce tenant all over the country need this rent by the room model is growing by leaps and bounds. So we getting $168,000 collecting rent from 14 tenants on an annual basis. Similar price point, 600K, but this 7 unit only collecting half, 80 grand gross rent. So do the math, do the simple sixth grade math. So yeah, this property cash flow, but how much? I don't know. Oh, I don't. Do I even have the numbers for the net cash flow? I don't even know. But let's say you get 25 or 30% down payment to buy this 7 unit property with an adjustable rate, maybe 7.5%, 8%. How much can you cash flow on $7,000 gross rent on a commercial loan in this 7 unit apartment building? I don't know, $500, $700 per month net cash flow. Not even near close to the $5,000 net cash flow you're getting from our co-living property. So, so that's pretty much conclude my presentation. I have given you to the best I could a apple to apple comparison of a new construction property in duplex. Very nice. Don't get me wrong. It's a A minus class, B plus class, quality asset duplex in San Antonio and two other properties in the Midwest. One in Milwaukee, Wisconsin, and the other one is in Columbus, Ohio. So what do you think? Okay, the numbers are are very, very different. Okay, you decide. What are your thoughts? I mean, what is your at the end of the day? What do you like? You know what I like, right? I like a lot higher cash flow, new construction, warranty, good quality tenant, turnkey, pass split. The marketing tech platform does all the pre-screening, getting the tenant. We rent by the room. We have a very, very good metrics. We have investors that have done very well the past couple of years buying our investment model. The average occupancy for our co-living properties is around 90 to 95% occupancy, and the average occupancy is around 6 to 8 months, sometimes longer. Okay, and it takes about 30 to 45 days for pass split to get the individual tenant to occupy those rooms. That's so the metrics are really good. All right. So with that said, so please, if you like the value of this presentation, comparing co-living versus other traditional apple to apple comparison duplexes at 600K. Yeah, please like and subscribe to my YouTube channel, and better yet, put your email into my newsletter, Yee Real Estate Network, my website, so you can become a free member of our real estate investing network. So you can get free content, free information almost every morning into your email inbox. So you can learn about real estate investing opportunity, what our network will provide for you, the whole 9 yards, and you could be part of an oasis of like-minded investors that are sharing your vision. You want to learn, you want to get educated, you want to get informed, so you can take action to buy, the kind of property that we promote within our network: turnkey, out of state, hands-off, cash flow, new construction properties in the best markets in the country, Florida and Texas and a few other markets. All right. So if you're really motivated, if our presentation really resonate with you, if you're motivated, if you financially qualify, if you want to get into the co-living investment portfolio acquisition mode, please contact me directly. My contact information is below on the description below you. So contact me directly for complimentary consultation. Then we talk for about 15 minutes by FaceTime, by Zoom, whatever, by phone, so we can determine whether your goals, your objectives are in alignment with the kind of property that we are promoting, the co-living, new construction, iconic one bathroom, one bedroom models in various great Sunbelt, fast-growing markets in the country, Florida and Texas. All right, thank you so much. This is SeeWing Yee from the Real Estate Network. I'll see you next time. Thank you. Bye-bye.